Malaysian tax law, the cessation of business is a crucial event that marks the end of a company's tax obligations for its ongoing operations. This moment determines when a business stops being liable for income tax on future activities, and it sets the stage for the final assessment of business income up to the cessation date. The law also outlines how assets, capital allowances, and losses are treated when a business winds up. According to the Income Tax Act 1967, cessation occurs when a business permanently stops trading or operating, not just a temporary pause. For example, if XYZ SDN BHD closes its doors for good on 31 July 2024, that date becomes the official cessation date for tax purposes. Understanding this concept is essential for business owners to ensure compliance and proper closure of tax matters. So how do you know when a business has truly ceased? There are several clear indicators: the sale of all business assets, closure or sale of business premises, termination of staff and operations, and legal dissolution or winding up. It's important to note that a temporary suspension such as closing for renovations does not count as cessation. Once cessation is confirmed, the tax implications are significant. Final assessment covers income from the start of the basis period up to the cessation date. Capital allowances can be claimed for assets used until that date, and any unabsorbed allowances may be set off against other income. If assets are sold for more than their tax written down value, a balancing charge applies. Losses from the year of cessation can be set off or carried forward depending on the law. Notifying the tax authority, LHDN, and filing a final tax return are mandatory steps. When a business ceases, the treatment of various assets becomes a focal point. Trading stock is sold and the proceeds are included in the final income. Machinery and equipment allow for a final capital allowance claim, and if sold at a gain, a balancing charge is calculated. Prepaid expenses are no longer deductible after cessation, while investment income earned after cessation is taxed separately. Let's look at some scenarios. If a shop closes permanently, business income is taxable up to the closure date. If operations are only temporarily suspended, it's not considered cessation. In the case of liquidation, a final return is required and capital allowance rules apply. If the business is sold, income up to the sale date is taxable and the buyer starts a new basis period. Remember, a permanent stop is key. Temporary suspensions don't count. Always notify LHDN and utilize losses as allowed by law. Wrap up: cessation of business under Malaysian tax law is defined by a permanent stop of operations. The cessation date is when the business officially ceases trading, and all income is assessed up to that point. Capital allowances can be claimed up to the cessation date, and balancing charges may apply if assets are disposed of at a gain. Losses can be set off against other income or carried forward, depending on the Income Tax Act provision. Most importantly, business owners must notify LHDN and submit a final tax return to ensure proper closure. Understanding these rules helps businesses avoid penalties and ensures a smooth transition during winding up or sale. Always consult the relevant sections of the Income Tax Act 1967 for detailed guidance.